All right. Hello again. Thank you so much for taking the time to join us today for this live webinar by Zenskar in collaboration with Mosaic. The primary subject for today is going to be around market volatility over the past few years, and especially after the COVID-19 pandemic. We're hoping for a super insightful discussion around how finance leaders of today can effectively sort of navigate these rocky waters. Yeah, this is what this is about. And to sort of facilitate the same today, we have Joe, the co-founder and COO of Mosaic, who was also previously a VP finance at Exoni. And then we have Saurabh, the co-founder at Zenskar. Thank you, Joe, for joining us. I'd love for you to introduce yourself. Tell us about your past work, what you've done before, and then followed by Saurabh as well.
Yeah, of course. So first, thank you to the Zenskar team for having me on. Appreciate you guys putting together an awesome webinar on a great topic, and I think a topic that's on a lot of people's minds. Prior to starting Mosaic, I spent about a decade in FP&A. So I started my career at the Big Four over at KPMG. Then I joined a company in the Bay Area called Palantir, where I got to go on a really crazy ride of hypergrowth with an absolutely amazing company. I got to learn a lot. And during my time there, got a lot of experience building financial models, working with investors, updating reporting, and figured that there had to be a better way outside of some of the legacy solutions in the market and doing everything in spreadsheets. So after Palantir, I did do some more stints as vice president of finance before finally, building the tool that I wish I had when I was operating in seat. So excited to be here today, and thanks again for having me.
Yeah, thanks a lot, Joe, for joining us, and welcome. So a little bit about me. I'm a co-founder at Zenskar. I primarily look at product and technology here. I help with business strategy and a little bit of content on the side. Before this, I have a background in computer science. I did banking for a bit, then ran my own startup. I was the CEO, co-founder of a B2B SaaS business. Ran that for like 4 years, sold it, and then moved to the US. Here I was head of product at a genomic startup based in New York before I co-founded Zenskar. So yeah, like I have background on the finance side, super interested in optimizing businesses and just like reading financial reports and trying to figure out like how to take the next step of optimization on the strategy side. So yeah.
Awesome. Okay. Thank you, Saurabh. Thank you, Joe. So starting off, we'd love to start this off with a little infographic that sort of outlines annual recurring revenue growth for various different companies across all sizes and stages. We can notice that there has been a significant dip in ARR growth for these companies across all segments. And yeah, this is in between 2022 to end of financial year in 2023, as you can see. Most segments have seen a dip, but the segment that has been hit the worst was the largest possible segment, which is over $100 million in ARR. So yeah, this is what we are sort of going to dive deeper into today. But I'll let Saurabh and Joe take over and sort of let them discuss the same as well from their lens in terms of what they saw over the past few years.
Yeah, I could jump in and start to talk about what we saw. So obviously, the world definitely changed as interest rates went up. There's a lot of macroeconomic factors at play as well, including current political atmosphere, wars over in Europe that significantly tightened, specifically tightened the software and technology segment. So in 2023, from our perspective, what we were seeing is there were still deals to be done. People were still buying, but things towards the middle of the year, towards the end of the year, got extremely tight. I think the reason they got tight, because venture funding has essentially dried up with the interest rates being as high as they are. Investors were definitely not investing at the clip they were investing in 2021 or 2022. And when that happens, companies have to be a lot more capital efficient or tight with their cash. And then we're seeing that, play out in sales cycles where companies are only investing in mission critical software. And even if the software is mission critical, you're seeing a lot more scrutiny in terms of the company buying software or buying things that aren't, absolutely necessary. So I think that generally explains the dip in the ARR growth that we're seeing year over year. But that said, I do think things have been improving slowly. Towards the back half of 2023, it felt like there, has been a light at the end of the tunnel. I think we're getting positive signal from the Fed that interest rates will start to get tighter and go down. That hasn't happened yet, but I think everyone is hopeful that around the June timeline, we'll see the first cut. And if that happens, and personally, I think if there's also a change in the political atmosphere, we'll start to see things maybe go back to where they were, probably not at the same levels, but at least improvement from where we are today. Saurabh, I don't know if you're seeing or feeling the same thing.
Yeah, that makes a lot of sense. And just the interest rates rising is something that's caused like a big effect on like funding in general. Like we've seen other founders as well talk about the same things. We've spoken to people who raised money in the 2020, 2021 years, and then the story is like so different from people who are trying to raise money a couple of years back.
Okay, awesome. All right. While we're on this subject, Joe, I'd love to sort of pick your brains on how should ideally startups be thinking about the market during this sort of a condition, especially startups that are in their growth stages between Series A, Series B, or Series C, in terms of growth rate, retention, burn. What's your take on it in terms of how startups at these stages should be thinking about the market?
Yeah, so it's a really good question. I think founders are incredibly perceptive, and I think they need to continue to be perceptive. And if there's fellow FP&A professionals or finance professionals on the line, it's your job to help your founders be perceptive and stay in tune with the market dynamics. Personally, I find following a lot of the great VC investors on Twitter, as well as some great info sources on Twitter to stay up to date on the latest news. And as you're staying up to date on the latest news, you can kind of get a pulse for what's happening in the market, in the technology environment, in the VC communities, and bring those things to your CEO, to your founder, and make sure they are aware of what's happening. And once you're kind of aware of what's happening and you recognize the situation that you're in and the type of environment that you need to operate the company in, I would say the first and next most important thing is figuring out what is the next milestone for the business. And maybe the milestone for the business in a great environment like we were in 2022, maybe that milestone has changed, right? So it's really important to get on the same page about what the next milestone in a volatile environment looks like, and work backwards to figure out how you hit that milestone. And the milestone that you set out should definitely be communicated to your board and to your investors, and everyone should be in agreement that, hey, this is a realistic milestone. This is what we need to achieve in this environment to get to the next step. And for a lot of venture-backed companies, that next step is generally the next round of funding. But that also can be adjusted, right? In an environment like this, maybe funding isn't possible. So in that case, you really have to think long and hard about what the next milestone is and have a backup plan. So if you can't get to that next milestone and it's a round of funding, then there needs to be a plan that gets you to break even or a path to profitability if that next milestone of a fundraise isn't possible. For us at Mosaic, we've been kind of navigating the volatility in the market with a couple of, for us, we call them North Star metrics. And the three North Star metrics that we really care about are our growth rate, our retention rate, and our burn ratio. So we kind of anchor all the decisions that we make around those three metrics. and really work hard to improve those, understand the benchmarks, and understand how we can continue to beat all of those benchmarks against our peers in the space. So for us, it's having a plan, it's having a backup plan, and then monitoring our North Star metrics and doing everything that we can to improve those. And the last thing I'll say is, in periods like this, it's really, really important to make capital last through the macroeconomic environment. I already mentioned this before, but there's just so much in play, right? There's the interest rates, there's the election year, there's a war going on in Europe. So all of those things need to be in your decision-making process, and they're all playing a role in how and when the markets might improve and you might see, a better atmosphere to operate in. But this for sure is definitely a difficult time for anyone in the SaaS space. I think we're all kind of feeling the same pressures. So you're not singled out. It's not just your business. It's actually everyone going through this. But getting through it together as a business and keeping everyone on the same page is really important.
Yeah, just continuing on that, like we both, Purv and I, we're not big fans of growing at any cost. So like the way we think about capital is there are two parts. Like one is for survival and the second is for growth. And it's fine to raise, the way we think is it's fine to raise money for growth, but we need to get to a place where you are self-sustainably survival, if that makes sense. So yeah, like it's not to say that that is the only right strategy. There are companies, massive companies that have been built by burning, with a plan. And like for example, Snowflake, they burned. I think they spent $1 billion or $2 billion, and when they listed, they were like north of 50 billion in valuation. That was a lot of capital generated by burning effectively.
Speaking of which, Saurabh and also Joe, in an environment like this, if you're not entirely focused on fundraising at a very strategic level, what do you think these companies at these growth stages should be focused on?
Yeah, I can start with that. So there are like various ways of trying to get to profitability or at the minimum break even. There are strategies on the revenue side that you can employ. There are strategies on the expense side which you can employ, and each aspect of the business has a different way to think about how to be efficient with your capital. And I think we'll cover that a little bit further into this talk. So yeah, I'll just leave that again for now.
Okay.
Yeah, and I think again, like if you're not focused on raising money in this environment, what should you be focused on? It's making your customers happy. I think that's always going to be the number one thing. Happy customers go such a long way, not only to like helping the company go through a hard period of time, but also in the future when the environment is better, you can lean on those happy customers. You can show that your retention has gone up, and you can show that you've added a lot of value for the people using the product. So I think when fundraising is what you're focused on, it's kind of all consuming, right? It takes the entire leadership team to be really dialed in. It's generally like a really big distraction and takes away from operating the business. So when fundraising isn't on the near horizon, it's actually a really cool time because you could focus inwards on the business and run the company as efficiently as you can, understand where the business is weak and what to improve. So I think, yeah, everything you mentioned earlier is definitely true, but focus on customers. You can never go wrong.
All right. But speaking of looking inwards, Joe, when you really think about efficiency, business efficiency, and maintaining your cash flows. Uh, how do you think about allocating capital very effectively in these sort of markets?
That's a really good question, and there's a lot of literature out there on growing efficiently and what does it mean to grow efficiently. And personally, as a founder, we've embodied this to its core, and would love to just give some practical guidance to the community here on how we at Mosaic employ the strategy across the business. And for the people on the line listening, I think it's really important to be efficient everywhere across every department. And it's probably not good enough if you're just efficient on your go-to-market department. So really what I want to do here is talk about how we went department by department to figure out, hey, what does efficiency actually look like? Is this efficient or not? Is this not efficient? And the burn multiple does not discriminate. So if you have an efficient go-to-market, but you don't have an efficient R&D department or an efficient customer success department or an efficient marketing team, then you're still going to suffer in that burn multiple. And the burn multiple is one of the things that is top of mind right now in operating in this volatile environment. So I didn't mention this earlier, but I lead our sales and marketing team. So I'll definitely start in my two favorite departments. So one of the ways that we make sure that our sales team, and our sales team is comprised of amazing account executives who close deals, and a world-class team of business development representatives who are really the business development side, building pipeline through cold calls, outbound emails. They leverage the content from our marketing team in amazing ways. So I'll give a shout out to those guys for absolutely killing it for us, and they're awesome. But how do we drive them towards efficiency, right? So the first way that we kind of looked at this was in terms of our AEs and having a quota to OTE ratio within the standard range of benchmarks. So for businesses of Mosaic size, the range here, you want your AEs to have an OTE that is their quota should be 4 to 5x more than their OTE. And I would say one of the traps that I see teams fall into is, sure, they have quotas of, I don't know, let's call it, 1 million, but they're only attaining, call it 60 to 70%, then your efficiency isn't actually as good as you think it is. So I would definitely start with the base pay, the variable pay to get the OTE, look at their quotas and make sure that that ratio across the team is in line with that. Again, I think 4 to 5x numbers, Iconic's numbers 5x, and then really look at what the quota attainment is to see how efficient the AE team is. So standard, I think quota attainment rates are between 60 and 70%. I think the top quartile achieve between 70 to 80% attainment. We're really fortunate that our team attains higher than that. So feel really strongly that our AE and our sales function is super optimized and efficient. But Saurabh, I don't know if you have anything to add on that point.
Yeah, I think this makes sense. And I think we are at the stage where we are still like experimenting with our sales function, and a lot of what we do is figuring out like what messaging works and how to actually build it into like a repeatable sales process. So yeah, we are a little bit early for these ratios, but yeah, these make sense for
cool.
A bit larger.
Well, yeah, as you guys continue to scale, hopefully the guidance here makes a lot of sense, and you could put it into practice as you continue building the business and the go-to-market motion. I think next up is definitely our BDR team, so our outbound team that's building pipeline. And the way that we make sure that this team is efficient is by ensuring that, again, their OTE to their pipeline goal is between a 5 to 15x multiple. So pretty wide range. We're fortunate to be up near the top of that 15x range. But this is how efficient is your outbound business development team at building pipeline. And if you can say, hey, if we hire one person, their OTE, we're going to get 15x more pipeline generation from them, that is a really good place to be, because these people are extremely ROI positive. They basically pay for themselves many times over, and they're a really, really good, efficient way to drive pipeline. You could very, very easily measure how this team performs in terms of the number of meetings they're booking. What I love about this team is they're highly competitive. So if you set the number at a specific number of meetings and everyone at the team is achieving it, then it's probably a good time to raise that number and push the team so that you can continue getting more return on that pipeline generation. Obviously, you should comp your team really, really well and pay them accordingly. But again, these folks that are worth their weight in gold and are a really efficient way to grow the business.
Saurabh, can you touch upon net revenue retention here, since it's one of your favorite subjects to talk about?
Yeah, I think getting a customer on board is one thing, and then keeping them around and actually being able to grow with existing customers is it's an almost like different problem that needs to be solved independently. And we've seen companies that really focus heavily on one and ignore the other. Companies that have like the most success with having high NRR ratios tend to be companies that are actually like actively focusing on them. We've seen some ways that people have tried to increase their NRR. Like the typical way, the old school way is actually to have a very person-intensive process in the upsell. Or like, let's say you have subscriptions, you actually have to have like a very active conversation with people to get the revenue up, like maybe sell an additional product or renegotiate deals. But there are, I think, like automated ways in which you can increase your revenue. I think we'll cover some of these more actionable tips a little bit later when we talk about cash flows. But just touching on it a little bit, you can tweak your pricing model and the kinds of deals you offer to your customer to actually help improve your NRR.
Awesome. Okay. All right. Before we move on to the next segment, I'd love to ask the audience to keep asking questions on the box down below, so that we could address all of them towards the end of the session. Please ask your questions at the Q&A tab. We have a bunch of them open already. Please do keep asking them throughout the course of the webinar. All right. How should finance leaders really think about their working capital requirements during market conditions like these? How should they think about runway, burn, and other capital efficiency metrics during this time? Joe, do you want to take that?
Sure. I think the way that we run the business is we always work towards having 18 to 24 months of runway available. And the first step to doing that is building a really accurate financial model. So definitely not talking about improving cash flows yet. The first step is understanding cash flows and being really, really dialed in, because in environments like this, if your financial model is even a month off, it could mean the difference between life or death. So you really want to be dialed in here, and everyone should be able to be at least 95% on their expense forecast. And if that's not the case, there's definitely more work that you can be doing to make that a reality. Where I see people really kind of struggle to understand their cash flows is when they're building their top line model. So again, for us, our North Star metrics are growth rate, retention, and our burn ratio. And with growth rate, the most important thing is our top line attainment. And I see a lot of folks make a lot of mistakes when they're building their top line model, not accounting for things like sales cycles or sales rep ramps or the ability for the business to generate pipeline to meet their top line attainment goals. So accurately forecasting, those things in an environment like we are, and making sure you have the most conservative assumptions available in the model will really help you, monitor the cash flows of the business and run the business with that 18 to 24 months of runway. Another thing is accurately forecasting customer collections and really dialing in like your day sales outstanding, understand what invoices are overdue, and having, really fine-tuned financial processes that make all of this possible. If you do have a dialed in model and you do have good financial processes behind the scenes, I definitely recommend reforecasting on a monthly basis just to see where you are against the plan, make any tweaks to the assumptions, and understanding the environment and how the environment affects some of the assumptions within the model, and really stress testing that as well. I think the best way to stress test it is through those monthly reforecasting process. How in sync with the business and the environment are you? And if you're there and you're at a place where your model is actually really good and dialed in, then there's tons of things that you could then employ to improve those cash flows. But I would say that's the first step.
Yeah, if I had to add to that, the things that you mentioned, like a sales rep onboarding time, the sales cycle time, um, and then payment terms, and then DSOs, like all these, effectively just boil down to one number, which is return on capital. Like I really like optimizing just for one number, and a lot of ratios that people typically optimize for are in some shape or another a derivative of the return on capital with certain assumptions. And to me, it personally always, whenever I hear a ratio, it always makes sense. Ratios typically come with like a rule of thumb, and the rule of thumb has some assumptions baked in, and it's really important to understand those assumptions and how they really tie into improving your return on capital number eventually.
All right. Okay. Awesome. But Saurabh, while we're on that subject, can you talk about how tooling can help with increasing cash flows or dealing with this sort of volatility?
Yeah, like ultimately, there are various actionable things people can do to actually improve cash flows. So, like to solve certain business problems, let's say first step is to increase predictability. You would probably have a subscription sort of recurring pricing plan. And if you had to improve your NRR, like I mentioned earlier, there's a way to tweak your pricing. Like with subscriptions, typically what tends to happen is you have to renegotiate contracts, or you have to upsell a certain module in your product, or sell additional services to increase your revenue. But if your revenue scales with the value that your customer derives, then you actually don't need to have these conversations again and again. And a very straightforward way of doing this is by incorporating some element of pricing that scales on based on value. People refer to these as usage-based pricing models. So once you start adding usage-based pricing to your pricing model, then your tooling requirements increase. The typical subscription tools sort of like don't really help you get there, or it's like really hard to set up. There's additional lag that gets added when you need to integrate your system with a billing tool, and then with usage-based pricing, the easy way to do it is to bill in arrears once you know what the usage actually is, and there you're sort of giving up some cash to make that happen. And a fix to that is to charge upfront and offer credits or some sort of like wallet balance that your customers can draw down, and then you can charge for overages. And now when you move from a usage-based price to a usage-based price with a prepaid component, now your infrastructure requirements get even more complex. So yeah, like tooling, like is having good tooling is like really important to have to be able to solve like some of these business problems that you face, especially on the cash side, and just keeping track of your invoices, whether people are paying on time, and having automated ways of following up. In addition to the usual manual ways, that's really helpful.
All right. Okay. But this also reminds me of leakages throughout the entire spectrum. How do you think companies at these growth stages should ideally think about leakages, and how do they stop them to sort of make the most out of their current customers?
Yeah, we've seen a lot of companies have this problem, and almost always the source of the problem is in some problem with the processes or just lack of automation. So sometimes people sell one product to a customer, and the certain, like we've seen this in a couple of companies actually, where before they moved to using us for their billing, they were billing customers only based on what those customers were priced for, and not based on what the customers were using. So there were some customers that were using a second product that they had no idea about, and so they were just actually like losing money. Customers are very quick to identify overcharges. They're not as quick to identify or even bring up like undercharges.
Joe, what's your take?
Yeah, I think we're in the B2B space, so leakage isn't as big as a problem for a business like ours as it is to someone who sells to B2C customers. I would say in the B2B space, definitely make sure you have a really tight grip around your accounts receivable and understanding what is in the overdue bucket, what is in the really overdue bucket. And then again, like going back to good processes, you should have a really good collections process to identify these things before they end up too late and you have to write off bad debt. But I think from my perspective, rather than focusing on leakages, what I like to think of is like, what is the inverse of that? How can we get some extra yield? Is there more cash that we can save or get back? And from that perspective, we've definitely done a lot of really cool things. So for anyone on the line, if you don't have a sweep account with your bank, you should definitely look into that. They're really easy to set up. They're very low risk. And it's a good way to get, almost 5% interest on the cash that you have sitting in your bank account. Another really good way is get a good card program. So we've got our friends over at Ramp, really good and easy ways to get cash back and funnel things through cards. If you're buying new stuff or new software or things in the space that you need to operate the business, there's a lot of great companies out there. One that we like is called Tropic, to make sure that you're paying, fair prices and the best price that you can. There's also great tooling out there on the accounts payable side, a tool called Glean that we use that helps us understand when our bill has changed, what's causing the increase or the decrease. It calls out the exact line items that have increased, or if there's new things on bills. This can get really hairy if you're using AWS. If anyone's just looked at those bills, feels like they're 100 pages and they grow another 10 pages every time you get a new one. So a lot of really good software out there to not only get more yield, but help you save some cash as well.
Got it. Okay, awesome. In the interest of time, I think this is a good space to like sort of move over to the Q&A part. We have a lot of questions, very interesting questions as well. Hey Joe, what are your go-to tools for forecasting?
Go-to tools for forecasting? Was that the question?
Yeah. Hey Joe,
what are your selfish
for? Sorry.
So that's definitely a shameless plug. I almost feel silly answering it, but we use Mosaic. Mosaic is a strategic finance platform. We connect with accounting systems, CRM systems, HR systems, data warehouses. We bring that data into our product. We create really cool and insightful analytics on how the business is performing. And then you could use those analytics, the data that you've integrated, to build a fully integrated financial model. It's really easy to update and maintain that. It's also really easy to change scenarios for us. So if we said, hey, volatile environment, maybe our quota attainment is, not 100%, but 95%. What does that do to our bookings target or our ARR goals or our growth rate? We could tweak ACVs really easily. So it definitely makes the forecasting process a lot more efficient and simple for us.
And another question, a follow-up question to the same for you, Joe, is how do you judge the accuracy of this forecasting?
I think it's actually relatively simple, right? So you have a quarterly goal from an attainment perspective on the top line. Did you get there or did you not get there? And if the answer is you didn't get there, understanding exactly why you didn't get there. So was it a pipeline generation issue? Did you guys not generate enough pipeline to actually meet the goal? And if you did generate enough pipeline to meet the goal, then it's understanding deal by deal, rep by rep, what happened. And that process is actually really important, right? Because if you talk to your reps and the reps are telling you, hey, budgets are really, really tight, everything is going for another round of scrutiny, or you have to build business cases for CEOs, and you haven't seen that before, that's a new muscle that the team has to build so that you don't miss in the next cycle. So from an expense side, it's generally relatively straightforward, vanilla. Most of our costs are people costs. We have that pretty dialed in. Again, we know our people and our hiring plans pretty well. And then the last bit is just the big rocks in the forecast. So who are your largest vendors? How much are you paying them? And making sure that the timing of those things are happening within the range that you expect.
All right. Okay. We have a question from Stephen Forth. What are the key things that determine net revenue retention? This is definitely a Saurabh question.
Yeah, net revenue retention is, in very simple terms, it's anything that increases. It's a way to measure how much your existing customers are going to get you in year 2 compared to year 1. So, this could be through upsells. This could be through just your revenue increasing by virtue of how you're priced. It could be due to churn. So if you have $100 in revenue today, on an average, how many dollars of revenue are you going to get in year 2? That's what it is.
And we have another question from Liam. How should one measure efficiency for verticals like finance and HR?
Yeah, I can take the finance part. So we spoke to someone who's done a lot of M&As and who's a finance leader, who's been a finance leader in a lot of fairly large organizations, taken them to IPO. His rule of thumb was that a typical financial operations team should not be more than 3% of a company's headcount. He's worked with companies where the number is higher than that, and in almost all cases, he said that what he's found was that the processes were actually really inefficient. There were lots of errors, and the setup was actually worse in a larger financial operations team than in a smaller team that's leveraging more automation and tooling.
Got it. We have another question from John on, for improving cash flows, is it better to invest in setting up a team or focus on onboarding the right tools? Joe, do you want to take that?
Yeah, I think it really depends on the business and the goals, right? So if there's definitely a lot of tools out there that will save you headcount for sure. And if they're not tools, maybe they're actually outsourced firms or agencies that you can spin up and wind down a lot easier than hiring a full-time employee. So I would say that it definitely depends on the use case. For something, like what Zenskar is building around billing, I would say that it definitely makes sense to invest in tooling in a place like that than hiring somebody to do a lot of manual work, monotonous work. That is definitely a role where you can get some really good efficiency through tooling. If it's something more critical to the business, like in engineering or building product or product design, I would say there's definitely still tools to make that more efficient, but that's probably where you have a bigger reliance on having the right team in place versus saving a couple bucks.
Yeah, makes sense. I think we have time for one last question, also from Stephen Forth. How does NRR differ by customer type? Are there SaaS verticals where NRR is higher or lower? I think he's referring to different segments, customer segments in SaaS, where net revenue retention could be higher or lower.
There's a really good report by this pricing consulting firm called Ivaka that goes really deep into how to think about NRR and how to optimize for pricing based on value. And NRR actually, I've not seen, or at least off the top of my head, I've not seen any stats that separate, that talk about NRR values by industry. I've seen reports that talk about how NRR functions based on how a business is thinking about NRR. Different companies in the same industry, I've seen widely varying NRRs based on what the team is optimizing for.
Got it. Okay, Joe, do you want to take a stab at that question too?
Yeah, I think NRR is it's an interesting metric, right? I think as a business matures, NRR is easier to increase, right? If you're an early stage company and you're selling one product, then it's really tough to get that NRR. So as a business matures, part of the strategy that they need to have is thinking about NRR and their strategy around net revenue retention. So I really love what you guys mentioned earlier about thinking through usage pricing models, because obviously, even if you only have one product, if people use it more, your NRR is going to go up. But I think it really depends on the size and scale and the maturity of a business and whether or not that needs to be a really important function. It's always important to have good retention, but you're going to need more products to sell and more things to expand within a customer. But in the early stages, that can be quite difficult.
Understood. Okay, all right. I think that's the last of questions that we're going to address for today. Okay, great. Thank you so much, Saurabh. Thank you so much, Joe, especially for taking the time and joining us today, and also proactively digging deeper into the entire subject of the conversation and also all the questions that have been asked by the participants. I'm also very sure that they've been answered very diligently at the same time. We have reached the closing time, not almost, after a wonderful and also fruitful conversation so far. I'll now let Saurabh give away his closing thoughts, followed by Joe after.
Yeah, thanks a lot, Joe, for joining us. It was, super, super insightful, and I think a lot of practical advice there, especially with, how to think about optimizing teams, related to specific functions in a company, and some benchmarks and rules of thumb related to that. I learned a fair bit.
Appreciate that, and thanks for having me, guys. And I'm an operator at heart. It's what I do. So it's been a lot of fun to talk about how we're kind of employing the strategies, how we're going through the volatile market, and ways that we've been able to overcome it. So hopefully any of the things that I shared can be helpful. And if anyone wants to reach out to talk more, my email is joe@mosaic.tech. And if they need help in reporting or financial planning, that's where we shine. So we'd love to talk.
Yeah, and if you'd like to reach out to me, I'm Saurabh at Zenskar.com. And yeah, we help with billing automation and revenue recognition and a whole bunch of other accounting automation on the revenue side. So think of us as almost like a revenue side ERP.
Great.
Really cool.
Thank you so much, Joe, for joining us. Really appreciate it. And
of course.
thank you. Thank you, Saurabh. Thank you to everybody else who's joined us today. This has been an enjoyable discussion. Until next time, thanks again.
See you
Catch you guys next time. Thank you.